index now stands at 108 even. But with gas prices so high and adjustable mortgages resetting at higher rates, household debt has ballooned lately. But are high levels of consumer debt actually one of the things keeping the economy growing strong? Let's get some thoughts from Nigel Galt, Global Insight Chief at U.S. economist, and Christian Weller, Senior Economist at the Center for American Progress. Nice to have you both, gentlemen. Nigel, that seems a little counterintuitive. Most people think of consumer debt as dangerous, but is it?
Well, taken to excess, of course it can be dangerous. But what we've seen in the last few years is the extension of the opportunity to borrow, for example, to buy houses, to people in lower income classes who previously would have been shut out of the credit markets. We've also seen, the opportunity for more and more people across all income classes to tap into their equity in their homes to finance spending on improvements or whatever. Now, can you take this to excess? Of course. We just have to look back at the subprime fiasco we have at the moment to see that there were excesses last year in that part of the market, whether it was borrowers not correctly informing borrowers not correctly informed about the risks. There were problems there. Things went too far.
Yeah, okay.
But as a broad sweep, it's a good thing, this extra availability of credit.
Christian, do you see anything good about consumer debt?
Well, fundamentally, consumer credit plays an important role. It allows people, for instance, to move into a home. But the question is really the excess question. And we have had a real excess when it comes to consumer credit in the last few years. And it's just simply not true that it's unequivocally has increased access to credit. I mean, if you look at home ownership rates, in particular for African Americans who already had fairly low home ownership rates to begin with, home ownership rates have actually declined in this market. What the market has done is it has forced people into higher cost credit, but that doesn't mean necessarily that more people had access to credit. It just simply means that the people who have credit are now more burdened by it. And I think that's really a sign of the excess we have had. And that ultimately spells trouble for the economy because we lived well beyond our means for the last 5 years, and now we have to start repaying those loans either through foreclosures or actually dipping deeper into our pockets to pay that. And that ultimately slows the economy.
Would that moment of truth, Nigel, start to erode at the economy if at some point, you have to pay the piper?
Oh, no question that you have to finance the payments, and I certainly agree that the last few years we've seen consumer spending growing year over year faster than incomes, and one of the major reasons of that has been the increase of credit, particularly home mortgage credit. And over the next few years, I would expect to see consumer spending growth year after year slower than real income growth.
Well, therein is the nut, Christian, that we will start to see consumer spending slow down possibly if Nigel's prediction is correct. And then what does that do for growth of the economy, GDP overall?
It's certainly a troublesome sign, and I think the only way you get out of this is faster income growth, because otherwise, if income growth stays where it is right now, we will have slower economic growth, and that ultimately is not very desirable. Let's say economic growth stays around 2% with productivity growth above 2%. That means rising unemployment, lower employment growth. And we knew that this is going to come unless somehow magically we manage to increase income growth beyond where it was in the last few years. And I think
Nigel,
that's really
is
the
that
question.
going to happen? Increased income growth?
Well, I'm not sure, that income growth will necessarily accelerate. I think that we're going to be looking for a different mix in the economy, an economy that is going to be less driven by the consumer, less driven by housing, more driven in particular by what's going on in the rest of the world, in the stimulus that we're getting to our growth here from export demand.
You're shaking your head, Christian.
Well, at this point, this is a little bit wishful thinking because all our exports gains are eroded by our import growth. And I mean, I agree. I mean, it would be wonderful if the rest of the world could pull us out of this, and ultimately export growth could actually translate into a shrinking trade deficit and ultimately more jobs in the U.S., especially in the U.S. manufacturing sector. But we have had a number of years of strong export growth, and it just simply hasn't happened.
Well, yeah, that's a tough vortex, and we're already getting sucked down into it. Our deficit with China is just gigantic, and we're buying all of their products. But let me just speak out, for example, about a consumer who's watching right now thinking, oh, well, if consumer debt is really what's bringing the economy up or at least holding it up there, I'm going to continue to charge my flat screen TVs. I'm going to continue to charge up a storm every time I go to Target, Walmart, Tiffany, Saks Fifth Avenue. Nigel, is this going to lead us to a point where the hole in the dike just breaks open and we've got a real problem?
No, I think that each consumer has to consider their own position and whether or not it makes sense for them to take on extra debt and not just thinking because that's what's holding the economy up, I need to spend. I mean, just one point on the exports and imports. Export growth is strong. Starting to see a turn in the trade deficit, even excluding oil. And I would note that with consumer spending growth slowing, if that happens, which we expect, that will translate into slower growth in imports, because import growth is very highly leveraged to consumer spending growth.
Anybody predicting any kind of real disastrous response to something that might happen? Christian?
Well, there are some people out there who are saying that there's a good chance of a recession. I don't really see that at this point. I think my biggest fear is that we're going to be in this holding pattern of growth around 2% or below 2%, because exports won't come onto the scene fast enough and large enough to pull us out of here. Really, I mean, we agree that is the one motor that could jumpstart the economy, and it really hasn't happened. Let me just make one point on consumer credit, though. The main point on consumer credit is what has driven consumer demand for the last few years is not credit card demand or credit card debt. It is actually home mortgage equity withdrawals. True, and true. That one has definitely gone away or has shrunk substantially, and that won't come back even if consumers wanted to borrow.
And Nigel, to your point that a lot of home ownership has happened because of this, now we're looking at ARMs, these adjustable rate mortgages that are resetting, leaving people with bigger mortgage bills and then saying, well, now what am I going to do? I've got this big credit card bill.
Yes, I mean, the higher mortgage bills that people are facing as their ARMs reset, if they're in an ARM, or if they maybe get into a fixed rate which gives them certainty but maybe is paying more than they were previously doing, that will be one of the factors that's going to slow down consumer spending growth over the next several years. I don't think it means that we hit a crisis or a crunch at some point, but it will be a drag on spending for a long period of time.
Nigel, Christian, thank you very much for your thoughts. Nice to have some more conversation on this topic. You're welcome. Scott?
And Liz, we've